So let's kick off. Let's take a look at the differences between ETF and index options. And really, when it comes down to the difference between the two types of products, they are effectively tracking the same index, but the biggest difference comes down to the fact that ETF and stock options are for physical delivery and index options are for cash settlement. What that means is that at expiration, if you are a buyer and you are in the money, those will automatically be exercised, and you will either have to take delivery or short sell 100 shares of the underlying stock or ETF at expiration if you're in the money. And if you're on the other side of the trade, meaning if you're an option seller and it's in the money, then you will also be assigned whether you're long or short 100 shares at expiration, depending whether you're call or put. Now, for most traders that are trading 0 days to expiration, this is expiration obviously happens every single day. This could be a bit of a headache of managing trades ahead of expiration, meaning if you're in the money, you basically have to make sure that you close out your trade prior to 4 p.m. Otherwise, you will have exercise and assignment risk. Something that many traders that are trading 0 days to expiration options do not want. And this is really where index options comes in, because whatever gains and losses you have on the call or put that you're trading, whether it's in the money or out of the money, those options will be settled in cash, or rather it's only in the money options that will be settled in cash. But whatever differences that you have in P&L, you will never have to deal with physical delivery. Whatever your P&L is, that's just going to be debited or credited out of your trading account at the end of the day. So it's a much cleaner way to trade, and you effectively avoid all exercise and assignment risk. And that's the biggest benefit to trading index options. The downside, really, there's really, in my opinion, only one downside to index options, which is their size. Most of index options are very, very large, and we'll take a look at that. S&P 500 is a $500,000 contract. NASDAQ 100 is a $1.8 million contract. Now, the exchanges that list these products have been trying to address this problem. The fact that most retail traders cannot access that type of size by listing smaller notional value index options. But the problem is that a lot of them are not very liquid, or certainly not as liquid as the SPX or NDX. And we'll take a look at that here in 1 second. But sizing of these products is really kind of the biggest drawback, in my opinion, for index options, especially if you're a retail trader trading with an account under $50,000, $25,000. These index options are largely inaccessible for those types of portfolios. ETF and index, ETF and equity options are all PM settled, so it's really easy to manage them because they all expire on the last print of that expiration date. Monthly index options, most of them are PM settled, meaning what you're used to with stock or ETF options, but some of them are AM settled, meaning they're settled based on the opening price of the day as opposed to the closing price of the day. It adds a little bit of complexity because the last trade is actually the previous day, and you basically hold on to a position overnight, and based on the first opening print, that determines the settlement of your options. Not something most people want to be doing with their options. It's pretty easy to avoid, but that is one thing to be aware of. And then the last thing is taxes. If you're trading in a taxable account, ETF and stock options are taxed at ordinary income. Index options have a preferential tax treatment, 60% long-term capital gains, 40% short-term, which means that your highest effective tax rate is lower when you're trading index options versus trading ETF or stock options.